Well, good afternoon, everyone. For those that don't know me, my name is Bob Goggin, and I'm the Chairman and Chief Executive Officer of the bank. And on behalf of the Board of Directors, I want to welcome you to the 188th annual meeting of the Hingham Institution for Savings. This is our 32nd annual meeting as a publicly traded company. It's a real pleasure for me to be able to do this in person again this year. It's been a couple of years. We've gotten by with the Zoom, but this year to be able to do it both in person and via Zoom, we've got a whole bunch of folks attending in that fashion is great. So hopefully we'll be able to continue to do this in both formats going forward. A few introductions that I need to make. We have present with us today Arthur Regan, who has been designated by the Board of Directors as the Inspector of Elections, a role in which Arthur has served for, I think, 27 or 28 years now. So it's good to have you with us, Arthur. We also have with us Matt Menard from our external auditors, Wolf & Company of Massachusetts, and attending via Zoom is Marty Kane, the partner on our engagement. Additionally, Samantha Kirby from our council, Goodwin Proctor, is also attending via Zoom. So we're going to conduct the meeting today in three parts. The first part is the formal portion of the meeting in which we consider the four proposals that are outlined in your proxy statement. After we have concluded addressing those proposals, we will adjourn the formal portion of the meeting, and we will then move to what we have traditionally done, which is acknowledging one of our colleagues who has made some really outstanding contributions to the bank this past year. After we have accomplished that, we will move forward to a presentation from our president, Patrick Goggin, with regard to the progress and accomplishments of the bank this past year. And after that, we will move to a Q&A session. We've received a number of questions digitally. And for those who are on Zoom, you're in listen-only mode. And you will be able to submit questions using the Q&A feature in Zoom if you so wish. And otherwise, we will entertain questions from the floor also. So with that, I also want to note that all voting is to be done in person or by proxy. Electronic voting is not available. So with that, I'm going to ask Mr. Regan to indicate the presence of a quorum. Arthur.
Mr. Chairman, on this particularly brisk last Thursday in April, there are an aggregate of 1,880,385 shares represented either in person or by proxy.
So there being sufficient shares in attendance, I will declare a quorum as present. Should be also noted that I have received an affidavit certifying that the notice of the annual meeting and proxy statement was sent to all stockholders of record as of March 1st, 2022, that the same was mailed on March 11th. Is there any shareholder present who has not voted who wishes to vote in person today? None? Okay, thank you. So the first matter to be voted on by stockholders is the election of directors. And there are 5 Class 1 directors who are nominated by the board for 3-year terms, each to hold office until the 2025 annual meeting and until their successors are duly elected and qualified. And those individuals are Howard M. Berger, Kevin W. Gorgon Jr., Julio R. Hernando, Ronald D. Falcione, and Robert K. Sheridan. Do I hear a motion that those nominees be elected as directors of the bank? We have a motion and a second. Is there any discussion on this motion before we proceed to a vote? Hearing none, we'll now proceed to a vote. And I'll call upon Mr. Reagan to announce that vote.
Mr. Chairman, each director nominee received at least 1,359,018 shares voting for their election, representing over 92.8% of the shares voting on this item.
Thank you, Arthur. So the holders of a plurality of the shares present are represented and entitled to vote at this meeting. Having voted for the nominees, I hereby declare those individuals elected. Next matter to be voted on by the stockholders is the election of Mrs. Jacqueline Youngworth as the clerk of the bank to serve until the year 2023 annual meeting of stockholders and until her successor is duly elected and qualified. Do I hear such a motion? It having been moved and seconded, is there any discussion before we proceed to a vote? Having no discussion, all stockholders present having been given the opportunity to vote, I'll call upon Mr. Reagan to announce that vote.
Mr. Chairman, our Jackie Youngworth received a tremendous 1,871,700 shares voting for her election as clerk, which translates to a spectacular 99.53% of the shares cast on the proposal. Bravo.
So the holders of a plurality, and obviously more than a plurality, of the shares present or represented and entitled to vote, having voted for the election of Mrs. Youngworth, we will declare that she has been so elected. The next item of business is the so-called say on pay resolution. The proposal calls for an advisory vote on approval of the executive compensation as outlined in our proxy. Do I hear a motion to adopt that proposal? Been moved and seconded. Is there any discussion on that motion? Hearing none, I'll call upon Mr. Reagan to announce the vote.
Mr. Chairman, a very supportive 1,401,760 shares voted for the executive compensation proposal, which is over 95.7% of the shares tabulated on the matter.
The holders of a plurality of the shares eligible to vote and present and represented either by proxy or in person, having voted in favor of the say on pay resolution, I declare that proposal to have been passed. The next item to be addressed is the proposed amendment to Article 16 of the bank's amended and restated charter. As required by the charter, this proposal, unlike the previous proposals, requires the affirmative vote of 80% of the outstanding shares, whether or not the shares are actually voted. So do I hear a motion to adopt that proposal? Second. Moved and seconded. Is there any discussion on that motion? Hearing none, I'll call upon Mr. Reagan to announce the vote on that motion.
Mr. Chairman, on the charter amendment proposal, 1,451,888 shares voted for its passage, representing an impressive 99.16% of the cast shares and 67.8% of the outstanding shares.
So less than 80% of the outstanding shares having voted in favor of this proposal, I declare the same as not having been adopted. It's worth noting that this proposal, if adopted, would have given shareholders greater rights to amend the bylaws of the corporation. And while this proposal was endorsed by the board, and supported by all of the inside shareholders. Apparently, the other shareholders are sufficiently content with the way our bylaws have been since 1989 that they did not wish to vote in a sufficient number to approve the proposal. The genesis of the proposal, I mean, we've always been satisfied with the status of our articles of organization and bylaws, but the genesis of the proposal was a comment from one of the proxy advisory services last year. They apparently thought that it was significant that the bylaws, that the charter be changed. But apparently, as I said, the outside shareholders are quite satisfied with our existing status. So we gave them an opportunity consistent with the proposal from ISS. And that's the status of that. So it is a little ironic that being one of the few banks in the country that management arrived here as a result of a dissident shareholder proxy contest, that someone might think that the outside shareholders don't have sufficient access to the conduct of the affairs of the bank, but we'll let that pass. So, as there's no further business to come before the formal portion of the meeting, I would entertain a motion to adjourn. All in favor, say aye. Aye. Opposed, no. So voted. So this is the point of the meeting at which we take a moment to acknowledge one of our colleagues who has really performed in an outstanding fashion during the course of the year. Now, let me say, the S&P Global performs an assessment of all the banks in the United States every year. And this past year, they categorized that banks up to 3 billion in assets, community banks between 3 billion and 10 billion in assets, and then those banks over 10 billion. So of all the banks in the United States this past year between 3 and 10 billion in assets, your bank was ranked #1 out of all those banks. There's a lot of banks in the United States between 3 and 10 billion. But based on a review of relevant financial metrics, Hingham Institution of Savings last month was rated the #1 bank in the country between 3 billion and 10 billion in assets. That accomplishment is not something that is the work of one person. It is really the work of an entire team striving for excellence and a continuous improvement. And I am honored to work with all of the folks, many of you here today, in that effort, and I'm very proud of that achievement. But we are recognizing one individual, and that individual is Salam Ayasu. And Salam joined us a couple of years ago from the Congressional Bank in Washington. And Salam is an assistant vice president and relationship manager. She works with some of our larger and more sophisticated deposit customers in the specialized deposit group. And she has done an absolutely fantastic job, holds herself to some very high professional standards, and has been very successful in assisting the entire bank in developing our deposit relationships. Patrick will comment later on the significant increases in commercial checking accounts that we have developed in the last couple of years. And Salam has worked not only in the Washington market, but also in the Boston marketplace. And I think she started to also work in the San Francisco marketplace a little bit. So it really is pretty remarkable what she's been able to do. So we congratulate Salam and thank her very much for her efforts in that regard. So with that, I meant to indicate we're going to do Q&A this afternoon until 4 o'clock, at which point we'll adjourn. But I think I've given sufficient amount of time to Patrick for his presentation and the questions questions that will inevitably follow. So with that, thank you very much, and I'll turn it over to Patrick.
Does everybody here and at home have coffee for this? Okay. Excellent. Thank you, everyone, for joining, both here and folks joining us remotely via Zoom. As in the past several years, we're going to walk through this in a couple of pieces. The first, a bit of a refresher for those who are new to us and those who are not, about what we do and what we don't do. So a little bit of an overview of the company, followed by a discussion of financial results for 2021, which were decent. And then a discussion of some of the operational highlights and I think some of the things that we see as key challenges going forward. We'll launch right into it. The safe harbor statement. As in past years, I'm not going to read this for you. It's in the slide deck that is on the website. And the essence of it is that to the extent that there are statements that we make today, either in this presentation or in the Q&A, that are forward-looking, essentially anything regarding the future, there are a whole bunch of verbs in there that you can read. We don't undertake any responsibility to update those in the future. Okay, so the pieces that I described, as in past years, beware of bankers or managers, whether investment managers or corporate managers, bearing quotes from Warren Buffett. 99% of the time, those are probably intended to deceive you. But in this case, the essence of the banking business is captured here, I think, so appropriately that we reuse this from year to year, which is to say that the real key to long-term performance in banking is avoiding mistakes, avoiding dumb things. It is not sort of a statement about the positive things one might do, but it's a statement about the things you need to avoid, which, as we get to, is really losing money. What we do, the three kind of core businesses that we've talked about in the past: commercial real estate lending, the beating heart of the bank in terms of the asset business, something that we've specialized in since 1993. And within that vertical, really, we're talking about a focus on multifamily lending, anything from relatively large apartment complexes to portfolios of 1 to 4 family non-owner occupied buildings. And then in some cases, we have borrowers that just have 1 or 2 or 3 families. And that's the sort of the essence of that business. We do some office and retail and some special purpose and some industrial, but that's really a flavoring. It's not the main dish. Commercial and personal deposit banking. There are 2 pieces to this. The first is our specialized deposit group, which is responsible for, by and large, our largest and most complex commercial deposit customers, including some personal customers that have unique needs. And then our retail banking group, which is the branch-based presence. So our office in Boston, our office is here on the South Shore, and our office out on Nantucket. And then finally, residential real estate lending, which for us is not a mortgage banking business. So as I think everyone here knows, and everyone joining us remotely knows, we don't sell our residential loans into the secondary market. So this business is really about deepening the relationships that we have with our customers across the bank, whether we have relationships in the commercial business or on the deposit side. And that's something that we've also done for quite a while. And we do quite a bit of value add lending in that business, where we're doing things that secondary market lenders can't do for our customers. More importantly, to the essence of that first quote, what don't we do? This list could be much larger, but these are all fairly common businesses in commercial banks of our size in the United States. So first, we don't do any commercial and industrial lending at all. So if it's not secured by real estate, but we don't do it. There is a de minimis exception where we've made a loan to a nonprofit here in Massachusetts, and their deposit balances cover that note several times over. But essentially, we are not in this business, so we don't do any asset-based lending. We don't have a leasing business, no loans and lines. We don't do any SBA business, which is a fairly substantial line of business for a lot of our competitors, some larger, some smaller. I think obviously no leverage lending. On the consumer side, if it moves, we don't lend on it. If it's credit card, boat, car, RV, planes don't show up here, but we don't lend on those either. Personal lines of credit, we don't do them. Nothing in investment management. We get questions about this. I would say frequently, given the demographics of the geography that we operate in, and this is something that we've really avoided entirely. So, in its wealth management iteration, we don't have a trust department, no advisory, no insurance brokerage. As particularly Massachusetts folks know, there are some banks here in Massachusetts that have fairly large insurance brokerage operations. We don't do that. We obviously don't have an insurance underwriting business. We don't sell into the secondary market. We don't do any tax credit lending of any kind in any of its iterations. It's a beautiful day outside, but we will not lend on your solar panels. And we don't participate in commercial mortgages. So we don't buy pieces of other banks' loans, which is, I think, a fairly common practice. And with one limited exception, a relationship that we have with a bank where we're an investor, we don't sell pieces of our loans. And we don't do that for a couple of reasons. On the buy side, really, you need to be able to evaluate the risks in these transactions directly. And in looking at the history of banks that have failed or have come close to failing, buying into larger banks' participations or not seeing those risks directly is a real common theme. It's probably one of the few commonalities in looking at a lot of bank failures. And then on the sell side, one of the reasons that we don't sell, as is common elsewhere, is we want to be able to control the relationship that we have with our customers, and we want to be able to control the terms of what we're doing with them. So if in the future we want to restructure that transaction or combine it with something else, we want to have the flexibility to do that. So a lot of things that we don't do, and I won't belabor that point. Capital allocation, as we've talked about in the past, I think it's important that this be upfront. You could imagine that the bank is capital that all of you as owners have entrusted to us to leverage and run the business. And every year we generate more of it. We need to make some decisions about what we're going to do with it. And management, whether at banks or at other companies, should not feel like that money is theirs. It belongs to the owners. And every year we need to be able to make a credible case that we can invest that incremental capital at attractive rates of return. Given the ownership structure of the bank here at Hingham, we have great alignment from the board and the extended families through the shareholder base. So in thinking about those priorities, organic growth is always the priority. And that's the expansion of our lending and deposit businesses in both the existing and new geographies. Massachusetts obviously being the oldest and deepest market. Washington, probably not a new geography anymore, given how long we've been operating there. Maybe we could call it emerging. And then San Francisco, obviously being somewhat new in this past year. Second, minority equity investments, some public, some private, focused on financial services and technology, much of which is financial in nature. In terms of financial infrastructure. Third, dividends. So maintaining appropriate leverage. We have had a regular and a special dividend since the change of control in '93 and shortly thereafter. An important, I think, governor on our use of capital in the bank, and I think keeps us honest about ensuring that the organic growth and and the equity investment opportunities that we make are hitting the appropriate hurdle rates in terms of returns. Finally, repurchase. This is something that I think we are open to. We've talked about that in the past. It is generally not an option that provides the same kind of returns that one might see from the others. But if conditions were to change, then I think that's something that we would be open to. There are some tax implications that we've talked about before because the lack of the holding company here at the bank. But as we grow in size, that becomes a little bit less relevant. And our ability to actually execute that in meaningful size is something that we're always sensitive to. And historically, that has been somewhat difficult. What's not attractive, control equity investments, which is 3 words that probably could have been substituted with 1, which is acquisitions. In almost all cases that we look at, when we look at the industry, those acquisitions involve prices that are too high. There's a loss of focus from the management team, and the cost synergies are elusive. We are very skeptical of the ability of almost all participants in the market to generate value for their owners through acquisitions. It is almost always the case in the situations that we've looked at that those acquisitions are undertaken to benefit management and not owners. And that's not who we're here for. 2021, like I said a little bit earlier, was I think a good year. I think we should all be somewhat cautious given how good a year it was, both in the core business and in our investment operations. And there'll be periods where we perhaps over-earn compared to our long-term returns, and then other periods where perhaps we under-earn, and last year was a very unusual positive year. These are GAAP earnings, which include the results of our investment operations, which last year and the year before were very positive. So a little bit over $67 million, which was a record, but we were also employing a record amount of capital in the business, which speaks to this question of returns on equity. So it's not the actual earnings, it's the earnings relative to the capital we have in the business. And last year was a phenomenal year, over 20% superior to 2020 and 2019, and probably at the high end of what we've done and what we're capable of achieving given the structure of the balance sheet. And certainly, I think favorable compared to some other groups, but as we've talked about before, that's not really the standard against which we measure ourselves. It's really an internal standard. Book value per share, a 5-year CAGR of 17%. Very positive results. In addition to that, obviously, the dividends that were declared last year. That 5-year CAGR is something that we pay quite a bit of attention to in terms of our ability to generate long-term value for our owners. In any given year, we may see returns on equity that are somewhat higher or somewhat lower. But in looking at a 5-year period, we really get a good sense of whether what we're doing in the business is generating sufficient value for our customers that they're willing to pay for it, and that allows us to generate these returns. Well, not so secret sauce to this, there are a couple of pieces to that. First, low cost leadership. We are, as I think everyone is aware, very attuned to the fact that we operate in a commodity industry. By and large, there are very few competitive advantages in banking. Every bank will tell you that they provide superior service, which I think quite obviously can't be true. There are very few product advantages in banking. We are not selling a sole source product. We don't have patents around money. So the ability to deliver value to our customers is reliant on our ability to take cost out of this model. That's really the product of 2 things that we've we've talked about in the past. The first are structural choices. So that's that first slide that says, these are all the things that we don't do. So that relates to what you might call game selection. So we have a couple of games that we've opted to play in. And then a variety of games that we've opted not to play in. And then operational choices is really how we play. So once we're in the multifamily business, or once we're focused on raising commercial deposits from a particular set of target verticals, particularly nonprofits and property managers, how do we go about doing that? And that really is where I think the concept of frugality comes into play. And I think that's also where sort of the great talent of a lot of the folks on our team comes through in terms of figuring out how to do what we're doing every year just a little bit better. Because that certainly does not come from management. You know, structural, those are the choices that we make. Operational, those are really the choices the team makes on the field. The lending business. So the last 5 years, very strong growth in this business, about a $3 billion portfolio we ended at the end of the year. And that was really driven by the commercial portfolio. So some really strong growth there, which was a function of a larger team, a really talented team of lenders, and the folks in our commercial processing group who have made this possible. Quite a bit of production here in Massachusetts, a very strong year in Washington, D.C., and really San Francisco was just getting started, so it wasn't yet a meaningful contributor. Easy to make loans, easy to show loan growth. Really the key test is, do we get the money back? And what you see here is the net charge-off record of the bank. So these are actual realized losses on loans, net of any recoveries that maybe we had through litigation. And the blue bars that you see here are the industry. So this is the percentage of average loans in any given year in the industry that were charged off on a net basis. The red bars are Hingham. Now, the last decade really for the industry has been a very, I think, positive credit environment. So you see some strong performance on a relative basis by the industry, you know, particularly relative to the great financial crisis, which is that, you know, big spike in the middle. But we've been very, very focused on not losing money, you know, not managing to a particular level of acceptable losses, but really undertaking to eliminate those losses altogether. And we'll touch on this on a few slides, but we really can't forget that this is the essence of what we do. And it's very easy, I think, for people to be complacent, particularly in the industry, with the loss experience the last 10 years. I think it's critical that we continue to understand that credit quality is at the heart of the business, and it's what we need to be focused on. The deposit business, slightly lower 5-year CAGR, but at, you know, roughly 12%, still very strong, driven by those two growth engines that we talked about earlier, specialized deposit group and our retail business. Our digital first efforts, while good, are not yet from a volume perspective delivering the kind of numbers that would move the needle that we see here. There are a few distinguishing features of that. You know, personalized service. Again, this is really table stakes. I would not describe it as a competitive advantage from an industry perspective. We have to be able to deliver it. We have to be able to deliver good service. And when we do that for sort of mid-sized nonprofits, family businesses, property managers, those other verticals, it can distinguish us against our competitors, and it can make someone move. Digital excellence. This is, again, I think, a table stakes feature of the business. You know, we may not be at the bleeding edge, but we need to be in a position to offer our customers the digital solutions and the payment solutions that they need, particularly on the business side. And then from a fee perspective, this is somewhat distinct. We've talked about this a little bit in the past, but a real emphasis on a no fee model, particularly in the commercial business. And I think we've talked through in the past why we think some of that is really required as both regulatory and market pressures start to compress operating margins on fee businesses. The two groups, the specialized deposit group, had a phenomenal year last year, about 30% growth in the trailing 12 months from March of 2022. And I think standalone in 2021 was about 31 or 32%. About 650 million in deposits, so a high growth rate, but still growing into the size of the balance sheet at $3+ billion now. One thing that we've been talking about for a bit internally, we have someone new joining to lead that group in a couple of weeks, and we're looking forward to that, and a new role for Holly, who's led that since inception here at Hingham. The retail banking group, again, I described a little bit earlier, that's just focused here in Massachusetts. So that's Boston, South Shore, Nantucket. And over the last couple of years, we've continued to consolidate some of those branches as customers' need for that transactional activity has changed, and they interact with us on a digital basis more and more, both for payments and informational requests. The customer support team, which is something new this year, it's really an outgrowth of some things that we did prior to the pandemic and during the pandemic. So a totally remote service team for folks who are contacting us via our main customer service phone line and email and chat. And something we think is critical to supporting a broader geographic footprint as we grow, and I think will give us the ability to extend some of our service offerings, particularly on the retail side, into the extended hours and weekends, and in some areas where I think customers have some expectations. Looking forward, there are a whole boatload of key challenges. I'll touch on a couple here, and then I think maybe we'll take some of these and handle them in questions. Yeah, the first thing is credit quality, and I emphasized this before. Really, it is the A and the Z of the business. We have had an extraordinary 10 years. Our portfolio, along with a lot of others, was tested during COVID. We certainly saw some very positive performance, but I don't think we can ever lose sight of the importance of that. Some of the different geographies that we operate in, again, I think we're going to touch on this during some questions, but there are unique challenges that we have as we grow in each one of those, and those are different and require us to, I think, approach solving them in different ways. Scaling the specialized deposit group, and this is something where we've had a tremendous growth on a percentage basis from a zero start. And we think that from a leadership perspective, growing the team and deploying technology, some of which is customer facing, some of which is probably internal, there's a lot of work that we have to do there that we're excited about. Process improvement, eliminating waste, this really is always on here. There's some questions, again, they'll touch on this. And I think I'll leave appropriate actually for some questions as well. This relates to some of the ways that we're thinking about how sort of the management team and the board will evolve going forward as the geographic focus of the business changes. So with that, I am going to switch to question and answer. And we're going to do this in sort of three ways. So there was a good list. I'll leave that up. There was a good list of questions that we got ahead of time. Folks submitted. And so we'll take some questions from that list. We have some folks who are going to submit questions via Q&A on Zoom. And then obviously we have everybody here in this room. And I'm only noticing now that I sit down, I can't really quite see all of you. So I think what we're going to do is we're going to take the next hour and 20 minutes to the extent that we need it, and we're going to alternate through those through those three solutions. So to kick things off, I'm gonna take the first question from Adam Mead, who wasn't able to join us today. He's on flight, but we sent a couple of questions in. And the first one, and this is one that I've heard from time to time, relates to our business in San Francisco. So for the benefit of everybody here and on Zoom, I'll read the question out loud and then we'll talk through it. So first, San Francisco. I understand and support the rationale for entering the San Francisco Bay Area market. My question isn't why now? Why not put more energy and focus in Washington? Is San Francisco that compelling, even in the face of the time and cost of doing business there? I don't know if Adam wanted me to add this tongue-in-cheek postscript, but he also asked, will these cross-country flights dash our hopes of ever achieving a single-digit efficiency ratio? So I think in thinking about San Francisco, we talked a little bit about this last year. It's useful to think of it as yet another step in how the bank has grown geographically, which is to say that when we first came here in '93, there's a very limited presence here in the South Shore. Over the course of that decade, the focus of the business shifted into the city as the bank grew, and as the focus on multifamily lending in particular grew. The opening of the office in Nantucket, sort of another step in that process of understanding that we can be more selective about the geographies that we operate in. They don't need to be physically contiguous, but they need to share common characteristics. And there's some benefit to us if the kinds of customers that we're banking are present in the markets. So in the case of Nantucket, it was a set of relationships where a lot of our Massachusetts customers and more recently Washington customers had homes there. There's quite a bit of overlap there. So it's been a step-by-step evolution of business. Adam's question is to why now? We had been looking in other markets for some time. We had some investments in our equity portfolio that were smaller, in some banks, in some other markets that were intended, like equity investments that we made prior to going to Washington from an operational perspective. Long story short, we had San Francisco on the docket. And COVID-19 really pulled a lot of that forward. It had always been something, or it had been something prior to COVID, that I think we would have thought was something 5 to 7 years in the future. And COVID really provided us with a unique opportunity that we did not think would be likely to recur. And that opportunity was that the pandemic had a really outsized impact. It had a substantial impact on both credit and real estate markets in the Bay. They had an outsized impact on those markets in terms of the perception of not just the sustainability of San Francisco's success, but the viability of the city. So the number of headlines in the Wall Street Journal in 2020 and in early 2021 talking about the death of the Bay, you think that there was no one left, and everyone that moved to Texas. And that was not a perspective that we shared. And our feeling was that that psychological impact on the market, both from a real estate and credit perspective, is something that we were prepared to exploit. We had already been doing the work. We had already put our eyes on the market. It was really a matter of timing. So accelerating the work in terms of engaging operational partners and conducting some of that diligence. That really goes to the question of why now. We thought that that was a unique opportunity where we could build some relationships with borrowers and with deposit customers that were not being well served by larger banks. And the optimal time to do that would be when times are difficult and our competitors are focused on different things, because the market certainly is competitive. It's less competitive than Boston in terms of the banking market. It is a competitive one. We thought that was a unique opportunity. The other dimension to that, and this relates to the question of why not put more energy and focus in Washington, is that at the same time, really started to develop, I think, substantial additional momentum in Washington on both the deposit side and the balance sheet. Some of that was a function of time in the market. Some of it was a function of the folks that we have on the team there, and folks that we were able to attract just before and during the pandemic, where we've been able to grow that business and grow that team of people in a way that gave me greater confidence that we could continue to move forward in Washington, and that would not be impacted by the resources that we're committing to San Francisco. Had we not been able to do that, then the attractiveness of the opportunity would not have mattered. We would not have had the capacity to do it safely and prudently. With respect to the cross-country flights and the efficiency ratio, I will confess that I have been getting even more space seats. So Adam may have to wait a few more years for that. I think maybe next we could take one in person if we have any, or we can go back out to the world. Okay, well, we'll go out to the world where we have 7. We'll start at the top, and this is from Leader from Israel, a longtime shareholder. Why do you avoid wealth management? How does this avoidance serve your structural operational choices? So there's been a long, I think, fascination in the industry, particularly in small and medium-sized banks, with the wealth management business. There are a number of other banks here in Boston that have long-standing trust departments. Sometimes it might appear in their name here in New England. And generally speaking, the attractiveness of that business to the banks that participate in it is the lack of a relationship between the fee streams that those businesses generate. Generally, it's a fee that's based on assets under management. Lack of a relationship between that fee stream and the net interest margin. That's viewed as very, very attractive. And the idea is that regardless of the size of net interest margin, the direction of rates, the macroeconomic climate with respect to rates, those businesses will generate fee income. And one would think that it would be particularly attractive in geographies that we operate in, because the demographics are, when you look at greater Boston, Washington, and San Francisco, I think quite really very, very affluent. There are a couple of things about the business that I think are problems from our perspective. The first is we don't know how to do it very well, which is probably the reason why we don't do most of what we don't do. And I think if most market participants were being honest, it would be the reason why most of them shouldn't do it either. It is a business where it is difficult to build sustainable competitive advantages. It is a business where it is difficult to build sustainable, positive operating leverage because of the ability of people in the business to move from bank to bank. And it's a business where I think we think that historically the fees that have been collected on assets under management are probably going to be subject to significant secular pressure to be reduced. I think that's something we've thought for a long time. It's something we clearly see playing out in a way in which the investment management business today is operating. It's really quite ironic in some ways that there are a lot of banks that are interested in getting into asset management at a time when those fee structures are under such tremendous pressure. And so that's something that I think has never been attractive to us, but there's probably a lot of fancy words in there. The key thing is we don't know how to do it really well. I tell a story when people ask me about wealth management of another bank. I'll say in the New England region, a little bit vague about it, that for some period of time had some content on the front page of their website that talked about investment opportunities in China. They weren't making direct investments, but it was more the phrase people use is thought leadership. And I remember quite distinctly reading it and thinking, there is no way that people at that bank, as nice as I know some that they are, have any kind of particular differentiated insight into investment. We certainly don't. So
Speak for yourself. Can I supplement that?
yeah.
You know, with regard to the wealth management and trust, there is a local competitor of significant size now that has trust in their name, and it's not that many years ago, probably 15 years ago now. And I remember talking with the CEO there and said, Bob, we've been in the trust business since we were founded 60 or 70 years ago. We've never made any money in it until this year, and we're barely making money this year. And my analysis is probably not as thorough as Patrick, but I look at a lot of balance sheets of competitors of ours, and they'll be similar size in terms of bank balance sheet. And then they'll have $4 billion under management, and somehow when they combine the thing, they end up making, you know, a third less than we do. So, and they don't break down many of these companies. They don't break down. They'll tell you the revenue from the wealth management, but rarely do they get into telling you what the net is from that. And when I look at the balance sheets and income statements of some of those companies, my conclusion is that they don't make any money from it. It may indeed constitute a bit of a drag on earnings. It's something we've avoided for all those reasons, and because we don't know anything about it.
And I will say that there's someone in the room who'll remain nameless for now, not a director or employee of the company or anything. He's a fantastic investment manager. So for anyone in person, I'll point you in his direction later. Okay, I think we'll go back to the list of questions that were submitted ahead of time. This is probably an important one. So Alex Cohen, this is in Alex's voice. During the periods from 2004 to 2007 and 2017 to 2020, when we had increasing interest rates in the U.S. and a flattening yield curve, Hingham stock flattened off. Stock is still produced. By the way, this is all Alex. I'm sure it's right. The stock has still produced impressive returns for investors despite those periods. I know you've spoken at previous meetings about how hedging interest rate risk does not make sense. I agree with you. What other levers might you have at your disposal to protect the bank's profits? Are there other lines of business that would either benefit from or be agnostic to a flattened curve that Hingham might be able to expand into? In your view, could this be done successfully without diversifying the already very successful banking? We've got a couple of things here. First, the structure of our business is clearly liability sensitive. We're structurally liability sensitive because of the kinds of commercial real estate loans that we make, which are not 30-year loans, but are not floating rate loans. And our customer segment in multifamily real estate, although they keep substantial liquidity with us, that doesn't fund the entirety of the business. And that's why we have SDG, why we have the retail bank, that's why we have wholesale funding. And I think it's important to think and maybe describe the way that I think about this is that we're not protecting profits in any given period. We're thinking about how to maximize returns on equity on a per share basis over a long time period, which means that there are probably periods where we earn, as I said earlier, outsized returns relative to that long-term trend, and then periods where we earn what are perfectly satisfactory returns back over history, with 1 year, 2 year exceptions, double-digit returns on equity, satisfactory, but not 20 or 21%. And that the choices that we made from a structural perspective about the business mean that we need to live with both sides of that trade as it occurs, but that over the long term, there are things that we can do to offset that. So the first thing we're always focused on, regardless of the level of the direction of rates, is establishing new relationships with strong borrowers, deepening the relationships that we have with the customers that we already have in the business. Because over time, those relationships, as the shape of the curve changes, those relationships are going to be the relationships that give us the opportunity to source an increasing volume of high quality assets. And those are the relationships that are going to form the core of the non-interest bearing deposits that allow us to earn those spreads. And so that's true regardless of the direction of rates. The second thing, which is implied in the first, really being focused on not losing money. And this is really important in periods when rates are falling, because that's often a period where there might be some lack of discipline in the market. There are periods, certainly in the last 10 to 15 years, where we've seen that as the case. And it can be true when rates are rising. We've spent some time talking in the past about what I think are some misunderstandings about the S&L crisis in the 80s, with respect to how a lot of those banks failed. And that was in periods when rates were rising. There were a lot of S&Ls who looked for assets that had yields that would offset the rising price of their liabilities. And those assets had risks that the S&Ls did not appreciate. And rather than accepting tighter margins through those periods where there were flatter curves, they resisted. They tried to protect those profits. And in doing so, they put assets on the balance sheet that when your capital is levered 10 or 11 or 12 or 13 times to 1, they put assets on the balance sheet of them under. I would say that I don't think about protecting the profits of the bank in any given period. We think about what that performance would be over a multi-year period. And implied in that is the idea that over time there will be duration premium, which is to say that longer term money will be more expensive than shorter term money. So periods of inversion, flat curves, although painful for us, are in the scheme of things likely to be more temporary. I didn't have any questions before, but rather than going right back to Zoom, I'll open that up. Adam had 3 great questions, and I thought about just answering those 3 to start, but we'll use one of Adam's. Yeah. Okay, so again, in Adam's voice, The loan book is growing exponentially faster than the management team, the executive committee, and the board, which has given us an enviable efficiency ratio. How will you manage to maintain your high degree of supervision and touch points, such as visiting every collateral property? I would say that's just as the bank grows. What is your current capacity in this regard, and how might the structure change as the bank grows to 5, 10 billion, etc.? I have a couple of thoughts on this, and then I think you have a couple of thoughts on this as well. I'd say that currently our capacity is pretty healthy to grow the way that we're growing in a way that is prudent, controlled, and safe. That there are investments that we're going to need to make, changes that we're going to need to consider as we grow. And that's something that we've been doing really the whole time, since the beginning. At every stage of our growth, we've had to think about how the involvement of the executive committee, the board of directors, the internal configuration management team, composition of the team, how those things will function, and then the use of technology. I break it down into, I think, three areas when I think about future pinch points or things that we need to be doing. As we grow, the first is really thinking about our processes. So we've been spending a lot of time trying to better standardize our internal processes, looking for unnecessary process loops, taking waste out, getting information in formats that allows for faster and more efficient decision making without a loss of control at the executive committee or the board, looking for ways to enhance our control infrastructure, sometimes by using external vendors that are real specialists in a particular task that we need to perform. And thinking about some of the risk-based standards that we have with respect to our approval levels. So in particular, our executive committee has always reviewed 100% of our mortgage lending from $0 up to our legal lending. And over time, the size of the loans that our board of directors has reviewed and approved on an individual loan basis has gone up. And that's something that over time, I expect that will continue to go up, and that's something the board reviews every year. From a management perspective, I think there are a couple of things here. First, at the board of directors, as we think about the board as we go forward, one of the things that we've talked quite a bit about internally, and I think will be important to maintaining the involvement of the executive committee and the board in our credit process, is having some folks on the board in Washington and San Francisco. The drivers of the involvement of the board in that process have historically been twofold. One has been a set of individuals that have tremendous personal capital and family capital at stake. There's a lot of skin in the game. And two, individuals that are in these markets and are familiar with borrowers, with buildings, with the built environments of some of these assets located in. As we think about those new markets and the board, that's something top of mind. The other thing internally, in terms of the management team, that we spent some time on in the last year, and I think going forward will be very helpful, both for the management team and frankly for myself personally, some of the changes that we're making with respect to someone new coming on to lead the next stage of growth in SDG, and Holly moving into a chief of staff role, which I think should give us a lot more leverage with respect to the size of that team as we grow. And then finally, and I think that this is probably the smallest, although it's the one that comes up most often, is that I think technology is very impactful to how we continue to grow. That there is really no one single bullet piece of technology that allows us to achieve the kind of performance that we want. Really, it's an approach that combines process discipline with the implementation of technology to get those results. And I think that that's an area where Dan Bagley joined us in the fall. We're very excited about. Dan's going to be able to play a critical part. And it's here. I can't see. There he is. He's all the way at the back. Did you want to touch on?
I just supplement what you said, Patrick. This is not a new challenge. We've evolved, when you think about it. John first joined us, we'll say, 26, 27 years ago, with $100 and some odd million. We're knocking on the door of $4 billion. And we have evolved over that period of time. Patrick just mentioned that. As many of you know, we increased the amount of loan size that requires direct pre-approval by the board of directors. That's gone up over time. We go up again. We go up some more. Adam, I think it's a great question, indicates what's the tax capacity, particularly in visiting every collateral property. And I think Patrick hasn't visited every loan that we've made in the new markets. We looked at that piece of property. We've also had a program in place in which we're bringing directors to those markets. We're looking at those properties with directors to make the individuals who are involved in that process of credit approval familiar with the neighborhoods and the varying values in those cities. So we'll continue to evolve. What we won't change, and what I think has always been at the core of our credit culture, is credit decisions are made by the executive committee. The executive committee comprised primarily of individuals with a significant portion of their net worth invested in this company. So they develop a certain level of expertise in terms of assessing properties. But having skin in the game is a very important and distinguishing feature between the little red line that you couldn't see on those net charge-offs for Hingham and the big blue line, which is the industry average. So I'm sure there are folks that are more sophisticated in their credit analysis than we may be, but it appears that one of the factors that impacts that net charge-off may indeed be the fact that the people making decisions here are risking their own money to a certain extent, and I think that makes a big difference. So that's going to remain at the heart of our credit culture, even though things will evolve over time as they have in the past.
Natural lead into to another question. This is from Josie's group. I've seen a video of Mr. Robert, and in it he said there was a banker in the early days at the bank that didn't believe in your centralized loan approval process. The banker, said it will never work. Please explain how the process works, and importantly, how it's different from other banks your size. So Yosi clearly recognizes centralized process. I think we've talked about it a little bit here. Certainly, we have enough people in the room that are on the board or involved in that process. It is centralized, and it's centralized at our executive committee, which is half of our board, and then to a lesser extent at the board of directors. And for the benefit of everyone, that differs from other banks our size, smaller and larger, in the sense that you might find at other banks that there is lending authority that is vested in an individual lender. Depending on that lender's experience, time with the bank, potentially they could authorize loans individually, or they could do so in conjunction with others. So two lenders together might be able to make a larger loan or authorize a larger loan. That is quite different. That is quite different from what we do. Anybody in the room again?
No questions occurring to you?
Okay. And so this is a little bit more specific. This is also from Adam Mead. How much growth in the loan book last year came from existing customers versus new relationships? And interestingly enough, it was not quite 50-50. It was about 50, somewhere between 55 and 60% of our new commercial originations last year were to existing customers of the bank. Either we had a deposit relationship and potentially no lending relationship, or their existing loan and deposit customers of the bank. And, the remaining roughly 450 million were customers that were new to the bank. And of that, roughly 60 to 70% were referrals from existing customers or from intermediaries that we had pre-existing relationships with, attorneys, accountants, brokers, other referral sources. Guy Barron, what are your expectations for deposit betas over the near to medium term Fed hikes? So for everyone's benefit, the term deposit beta refers to the link between a bank's deposit funding costs and what I'll say is the market rate for money as expressed in, let's just say the Fed funds rate. And if you had a beta of 0, what that would mean is that as the Fed hikes, your deposit funding cost doesn't change at all. If you had a beta of 100, that means that 100% of the Fed's changes in rates at the short end of the curve are flowing through to your deposit costs. So really the essence of the question is how much of the change in short-term rates we see coming from the Federal Reserve we pass through to our deposit base. And without getting into specifics, I would sort of emphasize again, as we talked earlier, we're clearly liability sensitive. And given the structure of the balance sheet, so not just our deposit portfolio, but the entire funding balance sheet, we are more liability sensitive than our peers. And in periods of falling rates, that's something that we benefit from disproportionately. And in periods of particularly quickly rising rates, that's something that we are certainly going to suffer from. To the extent that we continue to shift the mix ever so slightly in the deposit portfolio towards commercial non-interest bearing deposits, that has the impact of lowering that beta. That's a process that's been playing out for well over a decade as we've tried to shift that mix. I think that's a process that will play out over a decade more. There are no quick changes that would impact that for us. Josh, I apologize. I don't know if it's Stearman or Steirman. And this is Josh's question. The record of growing capital in a shareholder-friendly manner is impressive. As the bank continues to grow, is there any concern that there will be a time when the model cannot scale up any further? We depend on high-skill individuals with a particular mindset, and you don't just find those special folks on every street corner. Josh is absolutely right about that. We don't just find those special folks on every street corner. And I think that as we talked about earlier, At every stage in our evolution, we tend to solve a new set of problems. They haven't really been terribly distinct from the problems maybe we solved the year before or the year before that, in terms of understanding the markets that we're operating in terms of understanding the operational infrastructure we need, in terms of making sure that we have the right people on the team. So in thinking about a time when the model cannot scale up any further, I don't know that I have much of a perspective on that. I think we're focused on solving what I might call are the near-term problems. And solving those near-term problems, we'll quickly find ourselves at mile 20 or 22, a 26-mile race. The marathon does get run 1 mile at a time. Josh is right that the key limiter in the business is people. So trying to figure out how we can continue to attract very high skill individuals to the team and offer them a place where they can excel as part of that team. Something that I spend quite a bit of time thinking about. And that is the limiter. It's a small team. We have at any given time right now, say between 80 and 90 full-time equivalents in a company. I've grown a little bit over the last 6 to 9 months. But that means that everybody in the team needs to approach what we're doing with a set of skills and experiences, and a competence that is unusual. And for some people, I think that is compelling. And we want to find those people. And if any of you are watching right now, or more likely you're watching this recording 6 months from now on our website after maybe we've had an initial conversation, if that's the kind of person you are, the kind of environment that you're attracted to, then we want to talk to you, or if this is a future you, we want to keep talking to you. But that really is the limiter. We need to keep getting better at doing that. And that was a pretty quick one. This is from someone who's anonymous. How does the bank feel about using Federal Home Loan Bank advances to grow going forward? This one I'll let you answer because I think you've got a good story for it.
Patrick knows the story. I guess it was 28 years ago when I joined the bank. My first discussion with some of the federal examiners, they said, we note that you've got a few $1 million in Federal Home Loan Bank advances on your balance sheet. When do you intend on paying those back? And I looked at him and I said, never. Why? It was thought as at the time apparently by some folks that home loan bank advances would be temporary things. You just borrow the money when you needed it, and you replace it with deposits. And from my perspective then and my perspective now, money is money. We borrow it from a variety of different sources. We have deposits. We prefer the DDA deposits. Obviously, from a cost perspective, that is the most effective deposit gathering you can do. But in terms of certificates of deposit, there are periods when Christian can do a lot better borrowing from the home loan bank or borrowing from a variety of other sources than he can from Mrs. Jones down the street, who, like my dad in his later years when he had semi-retired, he would spend a lot of time driving around at that point in time from bank to bank, seeking the highest rate on a one-year CD that he could possibly find, and driving the bankers at those individual banks crazy, looking for 10 more basis points. So, yes, I think we feel pretty comfortable going on home loan bank funding for some of our funding needs.
That's wrong. Given the rising frequency of coastal natural disasters and Hingham's concentration in coastal cities, the firm factoring this risk in either on an individual loan basis or a portfolio management basis. I think the answer is yes, and it really manifests most clearly on an individual loan basis. You know, obviously, there are requirements that we have for flood insurance, which are industry-wide, but I do think we have some heightened sensitivity to, particularly, I would say, the problem of erosion. Some of the markets that we operate in here in Massachusetts, this is really less salient in Washington, really not at all there, and not at all in San Francisco, given where we've been lending. You don't have anything that's on the beach. But here in Massachusetts, there are some markets, some sub-markets that we operate in where there really is a distinct erosion threat that is not captured in flood data, and particularly down the Cape and the Islands. And that's something that on an individual loan basis we're very sensitive to. There are loans that otherwise I think would have been very attractive, but they were 30 to 40 feet from a bluff that was moving, and not 400 feet from that bluff. And there's certainly a number of loans that I can think of on an individual basis where we declined to move forward because of that risk. And it's invariably the case that those are valuable properties where even at modest leverage, the dollars of risk that we might have are fairly substantial. So going out and putting our hands on collateral like that, making an informed decision about the erosion risk is something that we've done. That's not something that we're doing on a portfolio basis, though. Anybody in the room? Go ahead. Actually, Gunnar, I'm gonna hold you for a moment. I think we have a mic just for this purpose. And if Eric's okay with it, you're gonna get to take it home with you.
Gunnar Peterson, Hingham shareholder from Cape. So I have a follow-on to Adam's first question. I remember when you went to DC, you liked the market and you liked, I think at the time you said, a relatively lack of competition, just a small set of competitors. Would you say the same about San Francisco? It's obvious that the market is super attractive, but what about the competitive dynamics in there, and like where do you see that you would fit in and have any advantages versus what I assume is a pretty aggressive set of competitors there?
There certainly is competition in both markets, and the question, just in case it didn't come through on Gunner's mic, was Gunner, correct me if I'm wrong, but to sort of talk about the relative competitive dynamics in San Francisco and in Washington. In both cases, these are clearly affluent, coastal, dense markets where there are a lot of banks. But in thinking about the competitive set for us, really we're thinking about banks in, say, roughly the 1 billion, maybe a little bit smaller to 10 billion range, which have the capacity to offer both on an individual transaction basis, but more importantly, on a relationship basis, credit to mid-sized commercial real estate investors, particularly in multifamily. The agency competition from Fannie and Freddie is present in every market. The insurance company competition, largely invariant to market, is going to be there. So really what we're talking about are banks. In Washington, there was a distinct hollowing out of those mid-sized banks, going back all the way to probably 2000-ish, a little bit after. And in San Francisco, the same trend has been present, and it may not have been as distinct in Washington, but it was a distinct one. So in looking at that 500 million to say $6 or $7 billion range, there were a lot of those smaller banks that had acquired, rolled up. There were some banks in the Bay Area that had been very acquisitive. There were, I won't call them failures, but there was some distress during the crisis that then was absorbed elsewhere. And there are a number of much larger banks that have a substantial presence in San Francisco. They're not present here in Washington, where I think we've been able to compete very, very effectively. And those banks are operating at a level of the market that we just don't see here in Boston. It'd be very, very unusual on a 10-unit apartment building anywhere in the greater Boston area to find Wells Fargo, for instance. And that is absolutely not true today. The other dimension is that there are some very, I would say, there are some excellent larger banks in the Bay Area that are more recently present here in Massachusetts that are very, very capable competitors in their respect. Great deal. But because of their size, particularly in the Bay, we're able to compete more effectively against them there because the time in the market there has been so great, and that means that there are customers that are perhaps dissatisfied or haven't received the attention they want. And so we've had some success with that as well. That same trend is present in terms of consolidation. It's not the case that we're in a rural market where there are 2 or 3 banks in any of the geographic areas that we operate in, but that slightly diminished competition in that particular segment is absolutely true there and true in Washington. And that is not true here in Massachusetts. And that's a function most powerfully of mutuality because of the degree to which this market is fragmented by the historical presence of that answers your question. Okay. Can you touch upon the technological investments within the bank you've made over the last couple of years, both on the customer-facing side as well as in the back office? And that question was from David. So I think there's probably a couple of different dimensions to this. Maybe we start on the customer-facing side and then work into the back office a little bit. On the customer-facing side, most of what we've done in the last couple of years has been largely incremental, which is to say incremental improvements in the core digital offerings for our personal customers, whether web or mobile, or for our business customers, whether web or mobile, or the payments interfaces that they're working with, most notably on the wire side. Probably the largest customer-facing investment in the last several years in the work that we've done on online account opening, which has gone through a couple of iterations. The first iteration was the use of a product from Fiserv, which provides our core ledger for online account opening. And I would say there was some success there, but we were not ultimately satisfied with that. And implemented a new product last year with a company called Mantle for online account opening. And there's some embedded things within that by way of fraud and security with a company called Alloy, where our ability to open accounts digitally in a totally straight-through manner, from customers' first interaction with the bank as a personal customer, through to the onboarding of that account and the fraud screening of that account, to the funding of the account, can be accomplished without any human intervention. Whereas the first generation of our online account opening platform, we could do maybe 80% of that. It wasn't truly straight through, And there were some things in there that we still needed to be going in and managing. And we weren't satisfied with that. So that was a fairly significant one on the personal side that was customer facing. We do have something coming up in this next year on the business side, which will be both, I think, impactful for our customers and a fairly significant investment for us in terms of dollars, which is a new cash management solution for our business customers, where our current solution is something that I think that we've gotten a lot of mileage out of, but the size and complexity of some of our business customers requires, I think, something much more capable. So that's something that we have on the plate. In terms of kind of what's described in the back office for infrastructure, one of the things that we had to do as part of that project with Mantle was work with Fiserv to build out an API layer that we could use to communicate directly with our core processor. So API, or application programming interface, the often used and maybe cliche at this point description of APIs. You can think of them Legos in some ways. So these are things that allow us to take our core technology platform and integrate it with third-party providers in a way that we could not, and do so in a way that is not custom but is reusable. So these aren't custom integrations; they're integrations that are using a reusable set of components, Legos, for lack of a better word. And the work around that, I think in the long run, is likely to be impactful, although it'll be impactful in ways that I think may be difficult to directly perceive right now. I hope that was helpful, David. Sure about that one. Are there publicly traded banks who aspire to or will share the same ethos outlook for management? I mean, there are a lot of wonderful banks in the United States. Some public, some private, some mutual. And I'd be real hesitant to I think touch on that one. I think that there are some instances where there are management teams that, if you were to look at some of the criteria that we specify with respect to equity investments, there are some instances where there are teams that are purely owner-oriented, are clearly focused on generating returns, are building businesses with a long-term perspective, and are very careful about credit. Yeah, I avoid naming any names on that one, but there are some great ones out there. Will the bank adopt Fintech and blockchain technology to improve liquidity, faster transactions in the near future? And that's from an anonymous participant. I think that the banking industry, and this is something we've talked about a little bit before, I mean, Fintech is a word that I would use if I were trying to raise capital from VCs right now. But the financial services industry has been using technology to improve experiences for customers and reduce waste for 50 or 60 years. The three large core processors are themselves amalgamations, particularly in Fiserv's case, of a lot of different smaller financial technology companies that either built core ledgers or built online banking products or built mobile banking products or have payment offerings. And so I think that the use of technology in delivering services to customers and reducing waste is not a new story. It's actually quite an old one. I think there's no bank in the United States that hasn't adopted a strategy of using technology to some extent to improve those outcomes for customers. Where I don't think we would be as interested or more focused would be areas where the use of that technology doesn't provide a distinct, meaningful, superior experience to a customer. And I would say that there are a lot of instances in which banks, particularly smaller banks, that I think are trying to identify ways to stay relevant to their customers, are looking to integrate technology solutions with their core, sometimes in a way that's not terribly seamless, deliver some product or service to a customer that customer can better obtain elsewhere. And I think we see this particularly in a lot of the varieties of person-to-person payments, where over the last several years, there's been a lot of banks that have implemented direct P2P Fintech integrations with their core, or been involved in Zelle, which is largely a banking industry sponsored product. And the reality is that most of the customers that had a use case to send $15 or $20 to a friend, or even somewhat higher numbers, they were using Venmo, and it was a great experience. And it was an experience that the team at Braintree, which was acquired by PayPal, spent a lot of time putting a lot of effort into. And there's really no reason for us to look to add some functionality to our app or implement some sort of separately branded name app to try and push that on customers. I think the key thing there is thinking about, is that thing something our customers need from us? Is that thing something that delivers unique differentiated value for them coming from us? And oftentimes the answer to that is it doesn't. And those are instances where I think we're likely to steer clear. And with respect to blockchain, I think that the advantage for that kind of technology versus what we're doing in our business in terms of our core ledger is uncertain. There certainly are some larger banks that are doing some interesting things in payments with blockchains, but I don't see that we would have interest in that at this time. Anybody else here in the room? Soren?
Holder from there's probably 5,000 banks or so in the U.S. Very specific strategy of going quality and type of people, very specific type of loan. Why do you think no one exactly copies what you're doing?
Let me take that first, Patrick. It is difficult to understand, and part of it is our strategy could be copied, but it's not only the strategy in looking at it, it's the execution of that strategy, and sometimes it's difficult to we formed that culture over a long period of time. We talked about centralized credit and so forth. It's difficult to just impose that on a bank that is not developed in that fashion. So I think the execution of the strategy, we would think some people might consider. Whether they execute upon it, I don't know. The other thing is, many bank managers I believe that offering every kind of product, and think of the focus that we're talking about, they believe it's necessary or somehow enhances their significance. The broader the range of products, the more complicated my task, and perhaps the greater I should be compensated. I don't know if that's the thinking, but I suspect in some instances it might be. That they view a more complex, although less profitable strategy as being deserving of greater rewards, which from my vantage point as a manager and as a shareholder, I would be much more focused on strategy and whether it can produce real returns for shareholders. So it's a great question. It's difficult to answer with any greater degree of specificity. Those are my thoughts on it.
I think that second piece is probably the root of concern, in the sense that you don't offer those other products and services. It may not be real bank or a sufficiently sophisticated bank, or a real commercial bank would have a sizable C&I business or asset-based lending, would be in the leverage lending business. Remarkably, some say relatively small in our size range banks. So I think that there's an economic component to it, in the sense that there is a belief that taking a series of return streams from different businesses, putting them together in one bank, that kind of diversification might be important from a return perspective. I don't think the data bears that out. But I think the more powerful obstacle about why there are relatively few people that copy what we do, and I would be very careful saying that, in the sense that there are some banks out there that do some things that look very, very similar to us. They did not copy us. In some ways, we copied elements of them, or probably evolved for the same reasons. They were not looking at what we're doing here. It was a cultural block. It was that feeling that you weren't a real bank without having those things. I think that that's very powerful. I don't think that can be overrated in terms of thinking about how corporate managers behave. And that's true in banking, and I think that's probably true in other industries too. In banking in particular, the institutional imperative is so powerful. If I had a nickel for every time someone said to me, other banks do X, then we'd be talking about a much higher return on equity, because it's a persistent refrain. And I think there are a whole bunch of reasons why that's true in banking in a way that is different from other industries, or maybe much more powerful. But that cultural institutional imperativeness to sameness. Other people do it this way, I should do it this way. Other people have this diversity of businesses in it that are seemingly complex and difficult to understand. And therefore, if I have some people doing that must mean I'm a pretty smart guy. I think that's the driver. It's a great question. Because there is nothing about what we're doing, like I said earlier, that's truly defensible from a product or a structure standpoint. I mean, we don't have patents. We're not sole source. We're not. We give away some of my We're not the only supplier of seatbelt buckles in the United States on FAA regulated jets. We're not selling some unusual part or fire suppression in a helicopter's fuel tank. There's nothing about what we're doing that's particularly unique and complex. And actually, in what we do, so if you think about the asset class that we really specialize in, it is the least complex of the sub-product types in commercial real estate. So, arguably, there is complexity in retail and office that is not replicated in multifamily. So, arguably, it develops some expertise in those areas, develops some sustainable competitive advantage. Multifamily, that is not the case. It's the most liquid. It's the area where there's the greatest transparency of costs. There's no data advantage. We don't know anything about these buildings that other people don't know or can't find out. That's I think probably a big difference.
Add to Patrick's comment, the sameness of the current behavior in industry is partially shaped by the fact that it's so heavily regulated, and that regulatory push promotes similar behaviors. You will hear frequently from regulators, you do this differently, or your process is different. Why is that? They're used to seeing a certain type of behavior or activity, and it takes some effort to educate them as to why, what the rationale is to do something differently. And we frequently observe the fact that the industry itself uses a set of consultants that they use the same consultants. They all use the same consultants. So they're getting the same advice. And in many respects, that's why they act and behave the same. Advice from consultants is I like it.
This one is online. This was from an anonymous viewer. What are the biggest costs you feel the bank can drive down in the short, medium, long term? I think this is actually a really important question. I'm going to answer it a little bit differently. And this goes to that question of structural choices and operational choices. And I think it is, and I mean this as nicely as possible, it's commonly misunderstood, I think, that we operate with the operating margins, the efficiency ratio that we have, cut or remove some costs. So implied in the question, what are the biggest costs the bank can drive down? I think isn't really the way that we think about operational leverage, the operating margin, efficiency ratio. Because the answer is there really aren't any costs that the bank can drive down in any kind of meaningful way. If we were to look over the last couple of years, you do see some lower occupancy costs as we've taken the branch network and consolidated it. But really, the efficiency ratio is not about driving costs down. It's about figuring out how we can perform and do so with the cost structure that we have, or spend more, but do so in ways that have strong operating leverage. And the way that we really get that operating leverage is by finding great people. We get the most operating leverage on finding great people that compensate well and that perform. And probably the second big class is the use of technology in some of the process improvement work that we talked about. We have a strong set of internal controls and processes, but it is remarkable to me having been at this for quite a while. Now, every day, every week, every month, we can still come in and find opportunities in our existing control infrastructure, in the existing process infrastructure, where we can make relatively simple changes to give us better control at lower cost, allow us to scale more volume over that process, and oftentimes have a better result for the customer. And that's not writing a big check. That's not bringing a systems integrator. It's not a lot of technology. That's often something that's fairly simple. So it's a non-answer to this question, but I think it's an important focus. It's not about being cheap. It's understanding how do we get operational leverage. Okay. Tim Farina, and this is Tim's question. Any thoughts on the equity investments as they grow as a percentage of the balance sheet? How do you think about risk reward here? Thank you. I think there is an implied percentage of balance sheet based on where we think about leverage, but when we think about the size of that portfolio internally, we most often talk about it as a percentage of shareholder capital. And that's something that's grown over time since we started doing that. As a percentage of shareholder capital, it's grown more rapidly during some of the periods in which we've been able to commit more capital to it because of the opportunities that we've had. I think we think about it as a meaningful piece of the business, both from a financial perspective and then also in terms of the opportunities that we have that are more intangible to engage with those businesses and sometimes with those management teams. And it's a long-term piece of the business. Given the investments that we have, our approach to that, which really is that partial ownership approach, what we own in that portfolio, we've owned almost all of it since the beginning. Size has changed over time. These are some companies that we've spent almost a decade now staring at. I think we think it's a meaningful piece of the business that we'll continue to do it. As we grow, it will grow in terms.
So we're approaching a 4 o'clock hour, so I think we could do at least one more call.
So Miguel Nato, you've touched a few times on your size as a competitive advantage. Can you expand on that a bit? Why is it easier for a smaller bank to provide superior service? I think there's probably some sweet spot that we're close to. And there's a couple of dimensions to that. In order to provide service to the kinds of customers that we're targeting, either from a deposit perspective or from a lending perspective, you need to be big enough to do a couple of different things. One, you need to be big enough to have a team that can deliver that service, that enjoys solving problems for customers, and that you can compensate. Compensation is not everything, but it's important. And so you need to be big enough to have that team. You need to be big enough to be able to afford the technology investments you need to deliver that service for customers or allow customers to consume that service from you. And you need to be big enough from a credit perspective that you can have a relationship business with borrowers that you're targeting. That's important because it reduces your cost of acquisition for every incremental piece of business. When we talk to that customer for a second or third or fourth time, it's less expensive to acquire them. Because of that relationship, it improves the odds that we capture all the deposits in that relationship. And So having the size to do that is important, and that's purely a function of capital because of the way that legal lending limits work. Our legal lending limit at 20% of shareholder capital. If you're going to bank borrowers, families, businesses in the markets that we operate in, Boston or in San Francisco or Washington, these are not places where you're going to do $10,000, $100,000 loans. It is likely that the loan size will be larger. And what that means is you need a balance sheet capacity to engage in that relationship. The flip side is that you need to be small enough that there's still a very hands-on approach to credit. And that means that you have the capacity to be flexible when flexibility is warranted and profitable for the bank. And you have the capacity to understand there's a credit risk here. It might flow straight through underwriting in a larger bank. It might check all the boxes, but we've seen that guy before. Where that property, the business plan for that property, it sounds great, but we know that that corner has never worked for a restaurant in that space under that apartment building. So there is some sweet spot there where the ability to combine all those advantages of size fits nicely with the advantages of being a little bit smaller. There's a trade-off.
So another one you think is important to answer as we approach the 4 o'clock hour?
So we had a whole bunch of questions from Connor Cochran. Connor, I apologize that we didn't touch a bunch of these. And for the questions that we didn't touch on today, and I think we're going to hit them in writing via an 8K that we did the same thing last year. Could you describe the strategy to grow the loan portfolio? It's the same strategy that we've had here in Eastern Massachusetts and Washington for however many years, which is to say, we can figure out who owns the buildings that we'd like to lend on. We've described that kind of that class of asset. It is not a secret who owns those things. And we figure out who those people are and who those businesses are, and call them on the phone, and we try and get in touch with them, and send them mail, and say we knock on their doors, but it's there's no silver bullet to what we're doing in these markets. It's making it known to the people that own the assets, the people that advise the people that own those assets, that we're interested in doing business, and that for people that have modest needs in terms of leverage and are willing to accept modest leverage in exchange for compelling rates, that we'd like to talk about. The brick by brick by brick is, I guess, the strategy.
Great. Well, the hour having arrived, I thank you to everyone, both those of you who are present physically and all of those folks on Zoom this afternoon. I've enjoyed the discussion, and thank you, Patrick, for viewing so many of those questions with us. I hope I see you all here next year. Actually more, maybe some of the Zoom folks will join us in person next year. We'll promise to continue to improve the refreshments. And with that, I want to thank you again, and have a great afternoon. Thank you.